Welcome to MacroHive Conversations with Bilal Hafiz. MacroHive helps educate investors and provide investment insights for all markets, from crypto to equities to bonds. For our latest views, visit macrohive.com. So greetings and welcome, Alberto. It's fantastic to have you back on the podcast show.
Thank you. Great to be here.
Great. Now, one of the reasons I enjoy speaking to you is that you're able to bring the big picture down to sort of the market level as well. So you're one of the sort of the few people in the market I know who still likes to sort of bring some of these larger themes into focus. And one of the things you've been writing a lot about in recent years has been this issue of the problem of debt and demographics, especially in the West. So perhaps can you talk a bit more about why you're talking about this, why this is important?
I think it makes a lot of sense to think about this. Before we talk about markets, before we talk about what happens in the next 3 months, the main issue we face is that the West has got too much debt. Western democracies are long-term bankrupt. Why? Because their growth model, the idea of capitalism, competition, productivity growth, in practice has failed. There's a lot of reasons for this, why the US, and especially European countries, have experienced low productivity growth and are experiencing low demographics. We can talk about why government investment in research infrastructure has been low. There's been concentrated gains and there's been socialized losses. When you have hoarding of assets, hoarding of capital, you don't necessarily translate that into productive investments. In the 60s, an 18-year-old person would have 80% probability of being richer than his or her parents. Today, it's a 50-50 game. There is less competition, there's more monopolies, there's more oligopolies. In the US, I would say every sector is clustered in 3 to 5 firms. So capitalism, in theory, should generate competition, gains in productivity, benefit the consumer. In practice, the Warren Buffett trade of the last decades has been buying companies with a large moat, which generate large profits for the shareholder, but also are less prone to innovation and generating growth. And by the way, they also have less incentives to pay workers, because in a monopoly, you have less places to work for. So in a way, the model of Western market-based economies based on competition and dynamism has translated into something more static, into a more entrenched capitalist model, where society has taken a hit too. Women now have kids in their 30s, not in their 20s. That's the median age in the US. Demographics are coming down, and that is obviously a negative force on growth and a deflationary force. So what are governments doing to combat this in the West?
And actually, before you go to governments, one question I had was, is this something to do with technology, would you say? Is it because we're in this era of digital this, digital that, so it naturally leads to concentration in sectors, or is this something else? Because a common thing economists would say is, technology is the ultimate driver of productivity, and things like that. So it's either like, is technology causing the concentration, which is bad, and why hasn't technology improved productivity? How do you think about technology?
So for sure, there is a winner-take-all effect, which has come with globalization and technology. But there's also a lot of pockets of hidden wealth that have not been tapped by governments. And the work of Gabriel Zucman and the hidden wealth of nations. And equally, there has been a lack of antitrust efforts, especially in the US. There is a very interesting book called The Myth of Capitalism, which talks about why capitalism today is a great idea, but we should actually try it, because there's clusters of low rates of encouraged consolidation and clustering of sectors and industries. So I would say that technology and globalization have created a winner-takes-all effect, rather than having 5 TV channels in every state. You're just everyone is watching the same, 5 or 10 best YouTube videos at each point in time, right? So there is definitely a winner takes all effect globally in some sectors, but there's also been a lack of redistribution of capital and wealth, and a very, at some point, regressive tax system, both in the US and European economies for the haves, while the middle class, and very well the elephant chart and how the wealth of the middle class has been evolving. The middle class has lost purchasing power, at least not gained in the West, while the top 1% has gained purchasing power. Now, if you look at the last work, the last Jackson Hole, not this year but last year, there's a discussion about the relationship between hoarding of capital and productivity. And obviously, when you have very concentrated capital accumulation, sometimes you don't have the reinvestment that you want to have. So it's a combination of factors. There has been an increase in concentration of wealth due to technology. There is a winner takes all effect. But I think some of the gains from technology have not been redistributed. And this is a discussion that's really actual now with AI and the potential for a substitution of large part of the workforce with automation. Will these gains be redistributed? Will people be able to retrain themselves? Because the result otherwise is having a very concentrated part of the population with a lot of wealth, and the rest with lower wealth. This also has a consequence for governments and the ability of governments to tax people. If you are, for example, in the UK, where 30% of tax revenue depends on the top 1% of the population, then your bargaining power as a government comes down, because obviously that part of the population is very mobile. And so you create a less stable social structure when you have a very extreme concentration in corporates, where large companies having a lot of power over smaller companies, which are the ones that innovate and create most of jobs. SMEs create 80% of new jobs typically, and you also create socially a very divided situation. So what we have seen really in the past few decades is low rates, corporate consolidation, the rise of oligopolies, reduced competition, reduced productivity growth. Is there a link across these things? Well, I do think that corporate inequality, corporate concentration is linked to very good dividends and payout for shareholders, but also to lower innovation. And typically, the companies that innovate are smaller. And so, in part, we have the result of all these trends: the inequality, the corporate consolidation, the oligopolies, the slowdown in demographics, creating a situation where there's just too much debt, and the West is struggling to continue with its growth model. And different countries are finding different solutions. But in the West, really only maybe Canada and Germany don't have a debt problem right now, but everyone else has.
And what's a way out of this debt problem?
So the good way out is growth. If AI generates a big productivity boom and we all become extremely more productive thanks to the use of technology, then we'll be able to generate more value and pay more taxes. And that's a good scenario, and it's possible. We're not writing it down. But right now, there are already concerns about the timing of this AI revolution. And there are concerns in the bond market about all the debt that countries are issuing. After all, we didn't really have a recession for a number of years. We had a growth shock during COVID, but since then, we've been in an environment of fiscal dominance where governments have been spending at a clip of near wartime deficits since World War II. So we are in fiscal dominance. And the Milton Friedman had an interesting point when he said, that there's nothing more permanent than a temporary government program. Once government starts spending, it's really hard to reduce entitlement, to reduce benefits. So if governments spend like this, and there is no immediate productivity boom, which is the first way out, then there's other three things that governments can do. Inflation, so devalue their currency, use central banks to absorb debt issuance. Default, which is not nice. It's painful. It's very disruptive. So it's not a favored option. And the fourth one is let other people pay for it. And that is essentially what the Trump administration is trying to do. But you can typically do it only if you have more power, if you are the bigger guy. So we're going to see a combination of these four options, of these four ways out of the debt problem being experimented by Western governments over the next decades. And obviously, as I said before, there are some countries that have more room to spend and are at a better starting point, but other ones are, already at the edge, let's say. And the UK is, for example, the one that's more on the edge of things right now.
And you mentioned Trump there. You almost kind of implied that, outside of the theatrics of, the way he announces policies and the volatility and so on, there is some underlying rationale for his policy, which sounds like what you're saying is it's related to debt or managing the debt side. Can you talk a bit more about what you mean by that?
So, after first months of turmoil, we've now had an experience of several months with the second Trump administration. And we can say that, what really the second Trump administration is trying to do is to contain and reduce their deficit. You can bring down to this principle all the policies that are being enacted. Domestic policy is about reducing entitlements and spending for healthcare, for welfare. And yes, they also are cutting taxes, but overall they're trying to reduce spending domestically. And number two is the foreign policy of the trade policy, where tariffs are, being raised in an effort to raise revenue. There's also an attempt to reduce political independence of the central bank, which I think acts as an emergency plan in case the first two measures wouldn't work. So if there is a steepening in the yield curve, the Fed becomes more dovish, and the Treasury also is very careful about the level of yields and has been trying to reduce maturities with, in part, potentially the help of inflows into stable coins and crypto. So I would say that all the deals that the Trump administration wants to look at are based on the idea that the US is spending too much, and the US is buying too much, paying too much for what it buys, and it's trying to consolidate its cash flow statement.
And on this, say the central bank side of things is perhaps the thing that's the bigger focus for markets at the moment, in terms of the growing loss of independence for the central bank. Is that a case of, in the end, this will be inflationary? So this is one of the paths to reduce your debt load. Is it what you were saying? Is it more a backstop, measure to be the buyer of last resort for treasuries? How do you think this will end up unfolding? Because if you speak to an economist, they'll say, if the central bank loses independence, inflation expectations could become unanchored and will unwind all the good, policy that central banks have done over the last 20, 30 years.
I think this is a point that markets are really underestimating. If we look around in the market, we see, stocks near record highs, credit spreads at 3-decade lows. In investment grade, we are, we're below 50 basis points, 0.5% of extra yield for investment grade debt versus treasuries, and high yield bonds are below 3% extra yield. So we're really not getting paid for the risk of something going wrong. And I remember a few quarters ago, I was meeting a central bank. I was in an investor meeting with a central bank, and very senior staff from the central bank asked a group of investors, including me, why are investors so bullish on everything? Why are investors buying gold? Why are investors buying stocks? Why are they buying credit and private debt at the same time? And the answer was, the question is not why are investors bullish on risk assets, but why are investors so bearish on central banks? I think that's the right question. That was my answer to the central banker. And I think that here, investors are hoarding any type of risk assets because they see the underlying threat, the underlying development, this deterioration in central bank independence, not just in the US, but also in some other countries. The UK, for example, is another case in point. Other countries that now are starting to have an entrenched inflation problem. Now, as you know, you might have read or seen from our previous conversations, also with you, we have been, very much, against the idea of a transitory inflation shock, because we continue to see persistent fiscal spending, and it is very hard for governments to U-turn on fiscal. But yes, if a new election, a new government could always do something else on fiscal. The problem that we face with central banks is that once independence is deteriorating, it's very hard to make it back. It's very hard to recover credibility. It's much harder than reverting a fiscal deficit, an excess fiscal deficit running at 6 or 7%. And so the attempts to create, a shadow Fed chair, to, replace Chair Powell ahead of time, or to undermine the work of several Fed presidents or governors, is something that we see in the light of fiscal dominance taking over the monetary function of economies in the West, and real rates for investors staying at very low levels. In other words, central banks controlling the curve in the front end, but also to some extent in the long end, for example, reducing quantitative tightening, which has happened, or with language, with interventions. And as a result, investors not getting paid much on risk-free rates on their treasuries or government bonds compared to where inflation is going to be. And we think inflation is going to be, above target. Essentially, central banks have already abandoned their 2% target by letting inflation run so much higher. In the UK, we have inflation well above 3, and in the US, it will be close to 3 into the end of the year. So what are the consequences here? I would say that if we look at markets right now, investors are definitely aware of the problem, but perhaps they're not really positioned in the best possible way compared to what could happen if inflation becomes entrenched and yields, start pricing that. At the moment this year, we're having very low volatility, record low equity volatility, rates volatility, credit spreads after April have retraced, as discussed, to a 3-decade low, and equity valuations are at record high. So, like you said,
I suppose one reason for this performance in risk is that, ironically, because of this political pressure on central banks, US, UK to some extent, and elsewhere, the market thinks, okay, the central banks are going to cut even more, which should be good for risk assets. So the market's looking at very sort of the short-term dynamic that, look, Fed cuts, central bank cuts are great for risk, so I'll just buy risk. And so, how do you, as an investor, think about sort of the timing of all of this? That on the one hand, they'll cut rates, good for risk, but in the long run, this will start to see inflation expectations rise, and further down the line, this could be quite bad.
I would say there is a very important consideration here to make, and we need to distinguish between paper assets and real assets, where paper assets are assets that don't have a claim on anything, any cash flow that is linked to prices going up. So a government bond is a paper asset, a fixed income government bond. A stock of a company that has pricing power, obviously a commodity or a convertible bond that has an underlying company with pricing power, obviously inflation-linked bonds, gold, real estate, these are real assets. So we definitely want to own real assets in this part of the cycle. But there are ways to do this, and at very tight valuations, I think that investors might be underpricing the shocks that we can incur in this regime change from very independent central banks to central banks that are maybe not so independent. There can be some shocks. We can, the first shocks that come shock that comes to mind is a steepening in the long end and a de-anchoring of the long end, where, with the 10-year rate, for example, going to 5%, we could see a number of repricings in asset classes. A number of companies also having trouble funding at a higher level on an ongoing basis. Many of the companies that refinanced in the past few years did so thanks to inflows into funds like private credit, for example, and the idea that rates would come back to a low level. But there are many capital structures that emerged, that were created during QE, during 1% rates, that cannot survive with a 5% base rate or a 5% 10-year rate. So I would say that the first shock that comes to mind is a persistence of inflation and a widening of long end rates. And that's particularly relevant for the US. The US economy runs on long end rates. So the Fed hike in the front end rates didn't really impact the real economy that much. It only impacted the 25%, unfortunately, the poorest areas of the economy, the smaller businesses that fund with a floating rate. But most companies fund with the mid to long end part of the curve. Different story for Europe and the UK, which function more on the front end. But so I would say this is the first shock. So against this backdrop of government, fiscal dominance, government crowding out, issuance of bonds, being hard to absorb, and then Treasury is trying to issue in the front end as a result. Against this backdrop, how are people positioned? How are investors positioned? Well, investors are still very long US assets. They're still very long tech, which is something that performs in a low rate environment. And there are long strategies like the balanced portfolio, where your main hedge is bonds. So you're long tech on the risky part of your portfolio, and you're long bonds on the low risk on the defensive part of the portfolio. And guess what? If we're in an environment where inflation is more volatile and de-anchored, correlations between stocks and bonds is no longer negative. So you have to think about the structuring of your portfolio differently. You have to use real hedges, so short things that can go down, rather than being long duration as a hedge. And on the long side, you want to consider not just tech monopolies, which can be regulated, can be taxed, in an environment where society is not as not as happy as before. And you want to consider commodities, you want to consider defense, you want to consider infrastructure, you want to consider areas where you invest alongside the government. And so we are really rethinking how we construct our portfolio based on this new regime. But I think that there's not a lot of positioning for that. And geographically, you want to not just be in the US, you want to consider other areas which already are priced for geopolitical risk and already are cheaper because of geopolitical risk, and where investors are already used to trading that volatility.
I mean, one area outside of the US that people have looked at various points of this year is Europe, especially at the start of the year because of the German fiscal side. Recently, of course, there's been some volatility on the French political side. I mean, do you still think Europe's a good story, or is this a case of Europe making big announcements and then disappointing with the execution?
So look, the consensus has been, let's see what happens. The consensus has been, there is this, 2 trillion announcement, but I'm skeptical. That's been the consensus, but it is happening, and we know that there is not just a large-scale investment plan in defense, but also in infrastructure across most European countries. And obviously, the engine of this spending is in core Europe, where the capacity to take on more debt is still there. I would say that this is not just cyclical spending, though. There's a lot of structural initiatives that come with it, which are maybe going a little bit below the radar, but that will create win-win situations. So in other words, can improve growth without adding more spending. For example, consolidation of strategic sectors like banks or telecoms. There's a lot of fragmentation in European banks. There used to be more bank branches than restaurants in some European countries. There's fragmentation in the telecom space. We don't have the national champions that the US has, and that can also create cost synergies. And also infrastructure, same story. And defense, more joint ventures. We won't have consolidation in the defense sector, but we will have more joint ventures across Europe in defense and infrastructure. So these are areas that create costless gains for these sectors. Same for the space industry. So Europe needs to become more independent in strategic sectors. And for the first time, we're seeing governments actually implementing this and pushing forward and reducing the red tape on these in these areas. So it's not just a very large spending plan with Germany leading it and focusing not just on infrastructure, not just on defense, but also infrastructure and a number of other areas. But also there is consolidation and synergies, which I think make Europe a more interesting place in relative terms in an expensive market right now. So if you want to be defensive, you actually want to have areas where you have better valuations and you have government support. So the central bank in Europe has more room to cut if they want to, because inflation is still relatively muted, and governments have a bit more room to spend if they want to in core Europe, because the level of yields is still relatively low and the level of debt to GDP is still relatively low. Obviously, there are some bottlenecks. France, Italy are closer to bottlenecks, but Germany is not. So going forward, you want to invest in jurisdictions that are unloved, in countries that own commodities, in countries that have good demographics and don't have an inflation problem. They've not used their debt limits already at the public sector or the private sector. And I think that's going to be very important. So we continue to see an expensive market right now. We're not chasing risk assets, but some of the special situations in Europe are very attractive. One last point that I haven't mentioned is that there could be, not in the immediate term, but at some point, there could be also a reduction in hostilities in Ukraine, and that could create a virtuous circle of reconstruction finally after so many years of war, which could also catalyze investment in the broader European market. So I think that's also a positive.
Now, we have mentioned the UK a few times, and the picture you're painting for the UK is quite negative. The question there is, in some UK markets perform relatively well, like the pound, for example. Now, some of that just could be weak dollar, so maybe we can leave that aside. But if you wanted to position for this more negative stagflationary debt, low productivity type scenario for the UK, what's the right asset to use to go short or to underweight to position for that?
So this is not something we are doing. I would say we don't like gilts or the pound particularly, but we've been neutral. But I have to say that this is not something we are trading, but the part of the population that is paying the price for stagflation is unfortunately the bottom 25%. Essentially, people that are more exposed to a rise in imported goods prices. So, for example, food. Remember, the UK imports roughly almost half of food items from the rest of the world, including Europe. 50% of vegetables is imported. So it's a very dependent country in terms of food and commodities. So the bottom 25% of the population will be, unfortunately, the most affected by low growth, weakness in the job market, and inflation. Now, if we look at government policy and what has been happening to defend the bottom part of the population, there are some measures that, in theory, are defending that. So, for example, reducing migration could, despite a lower number of jobs, could keep unemployment stable because you have less jobs, but you also have less job candidates. But in reality, there's been very little that has been done to reduce inflation or to improve competitiveness by this government, despite the idea of labor. And the UK remains very dependent on the top 1% of the population due to a policy of creating a Singapore-like economy that was obviously implemented by previous governments. And attracting, a very high number of large companies, a number of high taxpayers to the country, but without redistributing that wealth. So now, obviously, there's a discussion about a reform of the tax system, which is overdue, but it takes a long time to do all this. So I would say that there are areas of the world where let's say policy has more more room for maneuver than the UK. The US has more room for maneuver because they have, commodities, they have a very dynamic economy, a higher productivity, and also they can impose a tariff on other countries. The UK has less room for maneuver compared to the US, of course, and has a much higher debt level. But so far things are still okay. So we see still some potential for some positive change and some better communication by the government until until economic growth, until the cycle turns. But there's still a bit of leeway to do something right.
And just a final question now. We're in September right now. Investors will be coming back from their holidays into markets and so on. What do you think will surprise investors the most in the next few months as we go into year end?
That's a tricky question. I would say that until a few days ago, the consensus was definitely for deteriorating job market in the US, a Fed that would do 2 or more cuts, and no chances of a resilient economy, let's say. But I think that the US economy will surprise. I think the US job market is not in such a bad shape. There's been also a reduction in job candidates, a reduction in migration. We have seen from recent inflation data and job data that actually sectors that are cyclical, like airlines or cruises, or essentially retailers, are seeing more demand. And so the consumer in the US is actually not dead at all. Its consumption is growing at a lower rate than the run rate, but it's still growing at around 1.5% in real terms, which, considering all the volatility and the tariffs, is a positive. So I think that the expectation of inflation coming down, of the Fed having to cut a lot, of a deteriorating economy is wrong, and we'll see a surprise in the US economy. But at the same time, I think that the market and investors are not positioned for it. So this surprise, this upswing in value sectors, in spending in the consumer, might upset the market, because again, the market has been essentially positioned for a Goldilocks economy where you're long tech and you think the Fed is easing and is going to support zero cash flow assets or placeholder assets, and assets that are very sensitive to duration. When you have real growth economy, when you have the Trump administration pushing the sectors and the states that are going to, the constituents that are going to re-elect them, that are going to help them in the midterms, then that the market is not positioned for it. So again, I think
and I should just put timestamp as well, because we're recording this on Monday, the 1st of September. So we're recording this before payrolls and before the CPI data that'll be coming out. But of course, you're talking about broader trends rather than one specific number. So with that, thanks a lot, Alberto. Final point will be, what's the best way for people to follow your thinking or reach out to you?
Best way is to check out our website, which contains a lot of our content. Our newsletters are public. Our webcasts are public after a few days. It's andromedainvestors.com, or on Twitter, macrocredit.
Great. Excellent. So with that, thanks a lot, Alberto, and good luck for the rest of the year.
Thank you. Thank you for having me, and good luck to everyone.
Thanks for listening to the episode. Please subscribe to the podcast show on Apple, Spotify, or wherever you listen to podcasts. Leave a 5-star rating, a nice comment, and let other people know about the show. We'd be super grateful. Finally, sign up for our free newsletter at macrohive.com/free. That's macrohive.com/free. We'll be back soon, so tune in then.